1929, stock market crashes. Fortunes evaporate overnight, but some people, a small group, they don't just survive, they get richer. 2008, global financial crisis. Banks collapse. Retirement accounts destroyed. But again, some people see their wealth grow during the chaos. 2020, pandemic. Markets plunge. Businesses shut down. And once again, the same pattern. Some people lose everything. Others quietly accumulate. So what's the difference? What are the wealthy buying that regular people aren't? I spent weeks going through historical data, looking at what assets actually survived major crises in the last 100 years. Not every asset, not guaranteed protection, but patterns that repeated across multiple crises. And three things kept showing up. Three asset classes that didn't just survive, they often thrived. And here's the interesting part. Billionaires are positioning in these same three areas right now, today, in 2026, which suggests they might be preparing for volatility and economic uncertainty. Let me show you what they are, and more importantly, why they work. But before we get into it, quick disclaimer. If anyone promises you safety, guarantees, or quick returns with any investment, they're lying. Markets are unpredictable. Individual outcomes vary. This is historical analysis, not prophecy. All right, asset number one, physical gold. I know what you're thinking. Gold? That's the most obvious thing ever. Everyone knows about gold. But here's what most people don't understand. Gold doesn't work the way you think it does. It's not an investment for growth. It's insurance for preservation. Let me explain with history. In 1929, when the stock market crashed, what happened to gold? It essentially held its value while stocks lost 89%. Not because gold became more valuable, but because the dollar became less trusted. People panicked. They wanted something real, something that couldn't be printed, something that governments couldn't easily manipulate. And that was gold. By 1933, gold had preserved purchasing power. But here's the really interesting part. In 1933, President Roosevelt made private gold ownership illegal. Executive Order 6102. He forced Americans to sell their gold to the government at $20.67 per ounce. Then, after collecting the gold, he revalued it to $35 per ounce. Instant 69% gain for the government. Instant loss for anyone who complied. Why did he do this? Because gold was exposing how much they devalued the dollar. They needed to control it. And the people who held onto their gold, who kept it despite the order, they preserved wealth. Fast forward to 2008. Financial crisis. Stock market crashes about 50%. Housing market collapses. But gold? It went from around $800 per ounce in 2008 to over $1,900 by 2011. More than doubled. While everything else was burning, gold was climbing. Why? Same fundamental reason. When trust in the financial system breaks, people flee to gold. It's been that way for thousands of years. In 2020, pandemic hits. March 2020, stocks crash 34% in a month. Fastest crash in history. Gold dipped slightly at first because people were selling everything for immediate cash. But then, from March to August 2020, gold went from about $1,500 to over $2,000. New all-time high at the time. Why? Because the Federal Reserve printed roughly $4 trillion in a few months. People saw that money creation and thought, this is going to affect currency stability. Gold protects against monetary instability and currency debasement, which often, but not always, coincides with inflation. So they bought. And they were right about the inflation that followed. Now here's what billionaires understand about gold that most people don't. They don't buy gold to get rich. They buy gold to stay rich. It's not about making 10x returns. It's about making sure wealth survives when systems don't. Ray Dalio, billionaire hedge fund manager, he's been saying for years, everyone should consider having 5 to 10% of their portfolio in gold. Not as speculation, as insurance. Why? Because across major crises, currency collapses, and financial panics in history, gold has tended to maintain purchasing power. Not always price, but purchasing power over long periods. In 1920, an ounce of gold could buy a nice men's suit. Today, an ounce of gold can still buy a nice men's suit. The nominal price changed. The purchasing power in real terms stayed relatively stable. That's the key insight. Now, about physical versus paper gold. Large institutions often use gold ETFs for liquidity and ease of trading. That makes sense for them. But individuals who want control and insurance tend to prefer physical gold. Why? Because if the system breaks, you want something real, something that doesn't depend on a bank being open or a brokerage account working. That's a personal choice, not a universal rule. So, asset number one, physical gold for most individuals. Insurance, not speculation. Asset number two, income-producing real estate. Notice I said income-producing, not just real estate, not your primary residence, not vacant land. Income-producing, properties that generate cash flow, rental properties, commercial buildings, apartment complexes. Here's why this survived major crises. In 1929, yes, real estate prices fell significantly. If you were trying to sell, you lost money. But if you owned a rental property that was generating income and you weren't over-leveraged, you survived. Because people still needed places to live. Rent didn't go to zero. It adjusted down, but it didn't disappear. And the property itself was a tangible asset. It existed physically. Unlike stocks, which could theoretically go to zero, the building was still there. Location, leverage levels, and cash flow discipline mattered enormously. Over-leveraged investors didn't survive. But those with positive cash flow and reasonable debt did. 2008, housing market crashes, right? Prices collapse. Foreclosures everywhere. Looked like disaster. But here's what the mainstream news didn't emphasize. Investors who had prepared, who had cash, and weren't over-leveraged, they bought rental properties at massive discounts. Houses that were $300,000 before the crash were selling for $100,000 in some markets. And those investors turned them into rentals. And by 2015, those properties were back near $300,000 in many areas. But they'd been collecting rent the entire time. You know who did this at scale? BlackRock, Invitation Homes, large investment firms. They bought tens of thousands of single-family homes during the 2008-2012 period, turned them into rentals, and now they're sitting on billions in unrealized gains. Why? Because they understood the pattern. Major crises create opportunities in real estate if you have income focus and aren't over-leveraged. 2020, pandemic. Real estate market logically should have crashed, right? Everyone thought it would. It didn't. It went up. Why? Because the government printed money. Interest rates went to near zero, and people realized, I can borrow money very cheaply and buy a tangible asset that generates income. So they did. And real estate prices increased 30 to 40% in many markets over 2 years. Now, not everyone made money. If you bought at the peak in 2021 with negative or marginal cash flow, you're probably struggling now with higher rates. But if you bought income-producing properties with solid positive cash flow, properties that pay for themselves, you're likely doing fine. Because the rent covers expenses, the property sustains itself, and you own a real tangible asset. Here's what billionaires and serious investors understand. Cash flow is king, not property appreciation, not hoping prices go up. Cash flow. A property that generates $2,000 a month in rent and costs $1,500 a month in all expenses, that's $500 a month in positive cash flow. That property's market value could drop 30, 40, even 50%. It doesn't fundamentally matter if you're not selling. It's still generating cash every month. And in a crisis, cash flow is what keeps you solvent. So asset number 2, income-producing real estate. Properties that pay you monthly, not properties you're hoping to flip for more later. Asset number 3, this one surprises some people, productive businesses, specifically ownership in businesses that provide essential goods or services. I'm not talking about trading stocks. I'm talking about owning equity in productive businesses, companies that make things people need, food, energy, healthcare, basic infrastructure. Let me show you why this works with history. 1929, stock market crashes, prices collapse. But did every company go bankrupt? No. Coca-Cola survived. Procter & Gamble survived. General Electric survived. Why? Because people still needed soap, still wanted beverages, still used electricity. The stock prices crashed temporarily, but the underlying businesses kept operating, kept producing value. And the people who owned pieces of those businesses, who held ownership through the crash, they recovered over time. And then some, because by the 1950s, the stock market had fully recovered. And those essential businesses were even stronger. They'd consolidated, bought competitors who failed, increased market share. 2008, financial crisis, banks collapsed. But did Apple go bankrupt? Did Walmart? Did Johnson & Johnson? No, because people still needed technology, still bought groceries, still used medicine. The stock prices dropped temporarily, significantly in some cases, but the businesses survived and adapted. And the people who bought ownership in quality businesses during the panic at discounted prices, they made significant returns over the following decade. Warren Buffett, you've probably heard of him, he was buying equity stakes in 2008 and 2009 aggressively, not because he was gambling, because he understood that productive businesses survive. Businesses that create real value, that solve actual problems. And when you can buy them at a discount during panic when others are fearful, that's when you position. 2020, pandemic, markets crash initially. But did Amazon go bankrupt? Did Zoom? Did Netflix? No. They adapted. And some even thrived. Because people still needed to buy things, still needed to work remotely, still wanted entertainment. The lesson here is clear. Ownership in productive businesses, businesses that create value, that solve problems, that provide things people need regardless of economic conditions, that ownership tends to survive crises. Why? because the business keeps operating. It keeps generating revenue. It keeps producing value. And that value eventually gets reflected in market price, even if there's temporary volatility. Now, I'm not saying buy random stocks. Most stocks are speculative. Most companies fail eventually. But quality businesses, businesses with strong fundamentals, low debt levels, consistent cash flow, essential products or services, those tend to survive and recover. And billionaires understand this deeply. Look at what they own long term. Berkshire Hathaway, Warren Buffett's company, owns pieces of insurance companies, railroads, utilities, consumer goods companies, essential businesses. Why? Because Buffett learned this lesson early in his career. Productive assets that generate real value survive. Speculation doesn't. So those are the three asset classes: physical gold, income-producing real estate, ownership in productive businesses. Now let me tell you why this matters in 2026. Because billionaires are positioning in all three areas. And not randomly. Ray Dalio, I mentioned him earlier, his fund Bridgewater has significant gold positions. Not small. Substantial. Why? Because he's looking at debt levels globally, money creation, geopolitical instability, and he's preparing for potential volatility. Real estate. BlackRock, Brookfield Asset Management, Starwood Capital, they're still acquiring income-producing real estate. Not selling, buying. Even with higher interest rates than 2020, they're still buying properties with solid cash flow. Why? Because they expect continued inflation over time. And real estate is an inflation hedge historically. As general price levels go up, rents tend to go up. As rents go up, property values tend to follow eventually. Productive businesses. Warren Buffett, Berkshire Hathaway just reported over $300 billion in cash and short-term treasuries. That's a record for them. Why is he holding that much cash? He's stated publicly. He's waiting for better opportunities. Waiting for valuations to become more attractive. Waiting potentially for a downturn so he can buy quality, productive businesses at better prices. He's done this pattern before. Built cash during expensive markets. Deployed during crises. The positioning pattern is clear. When major investors start moving toward these three asset classes, they're not panicking. They're preparing for potential volatility and uncertainty, and maybe they're wrong. Maybe everything will be fine long term. The economy will grow steadily, markets will keep going up, inflation will stabilize, geopolitics will calm down. Maybe. But history suggests that volatility happens. Crises occur, systems face stress, and when they do, these three asset classes have historically provided some level of protection and opportunity. So what do you do with this information? I'm not giving financial advice. I can't tell you what to buy. But I'll tell you what people historically did during uncertain times. They allocated across real assets. They didn't put everything into one thing. They spread it out. Some gold for insurance, some real estate for cash flow and inflation protection, some ownership in productive businesses for long-term value creation. Why diversification across these? Because if the stock market crashes, but you own rental properties generating monthly cash flow, you have income continuity. If real estate in your area crashes, but you own pieces of productive businesses operating globally, you have diversification. If currency stability is questioned, but you own physical gold, you have a hedge that's worked historically. It's not about getting rich quickly. It's about preserving and growing wealth sustainably over long periods through different economic conditions. And here's the final thing I'll say, and this is where it gets interesting. Most people wait until the crisis to act. They see the news, markets crashing, they panic, they try to move their money. But by then, it's often too late. Prices have already moved. The opportunity window has closed or narrowed significantly. The smart money, the institutional investors, the billionaires, they position before obvious crisis, when things still look relatively stable. When everyone else is complacent, that's when they accumulate gold. That's when they buy income-producing real estate. That's when they build cash to deploy into businesses later. They don't wait for certainty. They prepare during uncertainty. So if you look around in 2026 and you see record debt levels, continued money creation, geopolitical tensions, inflation still above historical averages, economic uncertainty, maybe that's a signal. Not to panic, but to think about positioning. The three asset classes that survived major crises historically are still available. Gold, you can buy it. Real estate with positive cash flow. You can invest in it, even with smaller amounts through REITs or fractional ownership in some cases. Productive businesses. You can own pieces of them through stock markets or private equity if you're accredited. And maybe this time is different. Maybe modern economic management has solved historical cycles. Maybe technology changes everything. Maybe. But the billionaires aren't betting everything on maybe. They're looking at historical patterns. And history shows these three asset classes have survived and provided protection. If this changed how you think about wealth protection and positioning, subscribe to Decoding the Economic, because the next video breaks down exactly how to start building positions in these three asset classes. Even if you're starting with limited capital, step by step, the strategies exist. You just need to know them. This is Decoding the Economic, where we analyze patterns others miss. Thanks for watching. See you in the next one.